Hi everyone, Salena Kulkarni here from Phoenix Wealth Group, and in today's short video I want to talk about the two opposing views of whether you should buy properties and hold them in for an indefinite period of time versus trading and making profit as you go by buying and selling properties. So there are two very strong camps within the world of property which advocate two things. One group of people believe in trading properties to generate chunks of wealth and chunks of cash as you go. The other group advocate that you should buy an investment property and you should never sell under any circumstance. Now, what I would like to say is that there's probably some middle ground here, and you could probably think of those two schools of thought as opposite ends of the spectrum. On one end, there's constantly trade, which obviously the pros and cons of that are, one, you do get chunks of cash along the way, but the downside is that you are going to incur enormous turnover costs and purchase costs associated with those sales. You could also argue that an advantage is that you are minimizing your risk and exposure in the market at any one time because you're minimizing debt. But there's a whole raft of pluses and minuses with that. At the other end of the spectrum, you've got the people who believe in buy and hold forever. Now, the advantages to that are that you can refinance, you can access your profits to some degree. Also, you are not incurring those massive entry and exit fees on that property. And generally speaking, if you're in it for the long haul, the idea is that effectively those properties should go up over time. Now, what I would say to you is there's a whole sort of multiple shades of grey that sit between those two schools of thought as well. My personal view is that you should be evaluating your portfolio on a regular basis, and there's no right or wrong when it comes to real estate, but there is opportunity cost and preference. So the thing to understand is, by investing your dollar in a property over here, it may be preventing you from accessing other investments over here. Now, if this is a solid investment and it's performing really well, then great. But if it's not performing, having funds tied up in that investment could actually be preventing you from investing elsewhere where you could be making a whole lot more money, which is why I say that the way that you evaluate your portfolio is by looking at the opportunity cost of what could otherwise be done with that money. If you are interested in understanding or having your property portfolio evaluated, then please get in touch. Something that I'm really passionate about is that constant reflection and review when it comes to property, and I hope to speak with you in the future. Signing off, Salena Kulkarni from Phoenix Wealth Group.